Paul Sankey, lead research, Sankey Research. So topping out, Paul, welcome, by the way.
Thank you. Very happy
I would
to be
assume
here.
with a giant asterisk, which implies we don't have a bunker buster bomb taking out the Fordo nuclear site.
Yeah, I mean, I think that...
Or a mine laid in the Persian Gulf.
No, I think, look, Brian, what happened was we got chopped up. We were talking short down at 60, and it's gone up to 75. And I think the Wall Street view is that we're topping out here, that you should fade this move. But having said that, if you look back at the long history of let's bomb Iran, potentially, which has been a 20-year question mark, the question was always, what do you do day two? You can bomb Iran, but then what are you going to do afterwards? Nobody's going to invade, so you get a fragmented situation, probably with the Revolutionary Guard in charge, and you probably end up with a Houthi-style situation. That's the big risk. The dream scenario is obviously that Iran becomes a new democracy and we all live happily ever after. But, of course, the history of these things, if you look at something like Venezuela, is more like it's going to be an ongoing disaster area because nobody wants to go in there. So I'm very concerned about that side of the Iranian story. Now, having said that, Iran has never been a reliable supplier of oil. So we're not looking at a situation like an attack on Saudi, such as we saw in 19. And we also reflect back that actually you haven't had an oil supply crisis out of the Gulf that actually physically greatly affected oil markets since the 70s.
Yeah.
And that, of course, was a missile war against tankers, and that's not off the table. If you just look
that would be a super spike in the price, right? If we get some tanker that's hit by a rocket. Two just collided, but you could say, well, they just screwed up and they hit a couple days
that's
ago.
because they've got the transponders off, right? I mean, this.
Well, were they off? They got jammed.
Right.
What people were talking about.
So there's
right?
clearly issues, but the crazy thing at the moment is there's vast amounts of oil being delivered out of the Gulf in a huge rush to get oil out of the Gulf, and actually the physical outages have been in Israel. So I think this is a real plot twist, which is new this time, which is Israel previously wasn't a major gas supplier. Now it is, with the Leviathan platform shut down, 2 BCF a day. That's actually constraining Egypt's gas supply. It's desperately short energy, and so they're importing oil. An Israeli refinery has been taken out. So that's had a major impact. So I think what people have missed here is that the actual energy impact has been on Israel, and that's been what's hurting European gas prices, where, again, they're behind on building.
I know everyone wants to jump in, but this is fast money. It's a stock show. So what does this all mean for the Valeros of the world, the Exxons of the world, the Chevrons, the refiners, the Marathons?
The volatility is not good, right? So for the equities, it's almost an argument to be a private refiner because the market's not going to reward you with this level of massive uncertainty. It's very hard to capitalize an oil price here. The market, as you know, from the futures point of view, says this isn't going to last. It's heavily backwardated, and then it's very flat forever. And one thing I always point out about a flat futures curve for oil is that it's nominally priced. So actually, if we're in a world where we're trying to buy gold, hard assets, anything that's hard to defend against inflation, it's interesting that the oil price implicitly real is really backwardated, if you know what I mean. So if you would deflate it, that's a little bit of an involved point. But there seems to just be an absolute conviction on Wall Street, and I've been as guilty of this as anyone, that this is a peaking out. And in fact, a couple of big hedge funds I've been talking to this week are just using the argument, hey, everyone thinks fade this, everyone says, this is not going to last, and they're actually tempted to get back in. The original 40 call that we made was about if there's far too much oil, how low do we have to go to shut down US E&P? And in fact, what happened, as you know, is the US E&Ps cut back capex at the first sign of trouble. We've never seen them cut back capex with oil in the 60s as a preemptive move. And of course now, so the idea that they would just keep producing onwards and onwards. And finally, there seems to be pretty good demand for oil out there, but it is summer. So I think the real time to get negative oil is always after Labor Day.
So we've seen oil, the energy sector, underperform for quite a long time now. Is there some, I understand the potential pervasive bearishness and the profound backwardation that we don't really see that way. But is there anything that makes you bullish aside from everybody so bearish? I
mean, I genuinely believe that these oils will generate a cash return to shareholder that's undervalued in the market over time. But this is not a market that buys, the Warren Buffett school of Benjamin Graham style, present value of future free cash flows. And so even with the oil age seemingly lasting a lot longer than we would have thought 5 years ago, or certainly that was discounted in the market in 2020, 2021, when it was the energy transition and oil was dead and BP was saying, we're going to have to not be an oil company. Everything that's happened since then tells you the oil age, particularly the gas age, is going to continue for another 50 years. And the market's not paying enough for the cash returns that are implicit.
I know we got to go.